Hello and welcome. One real estate company in focus today is Puravankara Limited. This is after the company has received a board approval to raise up to about 1,000 crore through its QIP. But to discuss more, we have the group CEO, Mr. Abhishek Kapoor, joining in with us. Hello and welcome to the show, Mr. Kapoor.
Thank you, Anushi. Thank you for having me on the show.
So my first question to you is about this 1,000 crore of fundraise that we are looking at. How are we planning to utilize this funds going forward? Is it for new projects or debt reduction? Can you shed more light on this?
Look, currently, as you rightly mentioned, we have received a board approval. This is subject to shareholder approval. The approval is going to be valid for about a year. Our plan, as far as the final use of funds, will be closer to the raising of the capital. But having said that, it will be a mix of new acquisition in line with the growth plans, and of course, some part will also go towards debt reduction, and some part into the operations of the company. The idea is really to scale up the business. As you know, we have planned about 14 million square foot of launches this year. Last year, we opened about 10 million square foot of launches. So, the idea is to replace that inventory as quickly as possible. So new business definitely a focus.
Absolutely. And this 1,000 crore of fundraise that we are looking at, is this going to can you give us a timeline in how are you planning to set this up? Like, is it going to be for this year, or like it's divided between 2 to 3 years? How is it?
Look, as I mentioned, the validity for the approval by the board is about a year. So at an appropriate time, we have to go ahead and raise this capital. But having said that, of course, the deployment plan shall be within 12 months of the time when we raise the capital. Some of the debt repayment will happen right away. New acquisition will happen over a period of time. Operations also expenses will happen over a period of time. But what is very, very interesting here is that it's an opportunity for us to, also not just look at one part of the capital structure, but the entire capital structure as a whole. For the organization, keeping in mind where we want to grow the business over the next few years. Of course, this is one option. There are platform level transactions. There are other transactions in terms of raising capital that one can look at. And all of those options are also on the table for us.
Absolutely. So you've mentioned that you are going to be utilizing some of this for debt repayment. Now, we have noticed an increase in the last 2 quarters if the debt comes to the picture. But on the other side, you've also mentioned that the cash flows that are expected to accelerate over the period. So considering the whole of FY25, where does our net debt look like? Is it going to come down compared to the FY24 level or remain at similar levels?
Look, as I mentioned it in the past, we look at debt in two contexts. One is a context of an absolute number, which is net debt, where we have been hovering around the current figure for a while. Marginally, it has gone up, but if you notice, it will be somewhere between 2,100, 2,200 crores since about almost 12 to 18 months, almost 24 months, I would say. Now, having said that, I think the debt has to be looked at in context of the business that we do. If you look at, there's another data point which we publish in our reports, which is called debt per square foot of area under development, which effectively means is how much debt do I have on per square foot of area that is currently under construction. If you look at that number, that'll be around 870 odd rupees a square foot, which means that, on an average realization of say 8,000, between 8,000 and 8,500 between all the brands that we have, our debt is only is less than 1,000 rupees. So our goal is obviously to continue to keep that debt under 1,000 rupees while we scale the business. And that's important. The important part for us is the growth strategy, and we'll continue to focus on the growth strategy.
All right, that's fair. Now, I want to move on to the kind of performance that you've exhibited over the FY24 period, which was quite strong. 90% of pre-sales growth, 60% growth in collections. Can you reiterate for us now, seeing the kind of land bank, seeing the kind of launches that you've planned for the year, is this sort of the growth that we are planning forward for FY25 as well?
Look, that's a good question. So what we did last year was essentially we got sanctions for about 10 million square foot, of which we opened about 7 million square foot. For sale. These were new launches. This year, our target is to get sanctions for about 14 million square foot and open about 7.3 million square foot as it stands today. Having said that, obviously there are new acquisitions. For example, we did a new acquisition in Thane, which was about 12.75 acres, which is not factored into this new launch program. Having said that, our obviously, while we don't give any guidance numbers, our target is always to outperform the market, given that the fact is that the market is consolidating towards large branded organized players. Our goal will be to continue to scale our operations faster than the growth in the market, and I think we'll be steadfast in that direction.
Mr. Kapoor, I do take note of you not guiding on the future, but again, if I even look at your revenue, you've shown about a 60% growth in your revenue. But if I were to look at your conference call, you've mentioned about 3,500 to 4,500 units of delivery that is expected over this fiscal, which is almost double if you consider we had almost 2,600 units delivered in FY24. So again, can we look at the 50% growth for this year as well, or is it remaining in line?
Again, good question. So look, our deliveries have to catch up with our launches, clearly. And this is, post-COVID, we had a disruption, and now, the operations are falling in line and getting into tandem with the new launches that we're doing. And these deliveries will continue to scale up as we go along. Having said that, as you rightly pointed out, we are looking at this year targeting around 4,000 units to give possession. And again, next year, our target will be to increase that possession numbers, basically in line with whatever launches we are doing in a year. So the gap really is, let's assume that we do a launch in this year, the delivery really happens in the fourth year. So the increased velocity of launches or increased volume of launches will actually have impact on deliveries over 2-year, 3-year, 4-year time frame, depending on, what kind of project it is. Is it a plotted development? Is it a mid-income development? Is it a premium high-rise development? So on and so forth. So we will continue to see a scale up of deliveries as we go along. And really the focus, as you rightly said, is on pre-sales, making sure the cash flows are really, really strong. Your operating surplus is strong, and that eventually will convert into deliveries and eventually will convert into, profits and balance sheet improvement.
Absolutely. Now, shift focus to another one of your brands, that is the Provident, which is on the affordable side. Now, with the government's decision to build about 3 crore of additional more homes, I know that the current focus is divided between the luxury, affordable, and all that. But with this decision coming in place, how do you stand to benefit with this new opportunity coming in for this brand in particular?
Look, as far as Provident is concerned, our target audience is really somewhere between 55, 60 lakh, going up to about 1.2 crore. What government is talking about is a different category of affordable housing. Currently, from commercial viability point of view, we will continue to focus on this space in all the markets that we are present in. And of course, the HDFC platform transaction that we have done, the capital raise, has been done only for Provident Housing's growth plan. And I think we will be able to continue to scale our operations there and continue to show margins there. Really, the idea is basically, if you look at the overall group structure, in terms of what we target as business, we look at about 35% of our business coming from Provident, about 35% in terms of value coming from Puravankara, and then about 20% from Purva Land and about 10% from commercial. That's the eventual goal that we're working towards. So I think the plan right now we are executing is in line with that.
Absolutely. And last question for you. You're eyeing for more opportunities in the NCR Delhi region. So wanted to understand what is the kind of growth that we are seeing in that area, and how are we expecting to go forward with this?
Look, it's early days. We just have decided to kind of look at that market. What we have done currently is kind of put people on the ground in terms of evaluating opportunities there. Clearly, to start with, we are looking at Gurgaon and Delhi as area of entry. And I think we will continue to evaluate those opportunities. I think NCR is a very big market. It will continue to scale. And we will be an active participant there because we aspire to be a national developer. We already invest in South. The real big piece that was left for us is NCR. And this will complete that perspective for us. And eventually, we are hoping over the next 4 to 5 years we will be able to build a decent, portfolio over there. But the entry strategy will start from Gurgaon and Delhi, and from Puravankara's perspective, it will be for brand Purva.
Well, thank you so much, Mr. Kapoor, for joining us and sharing your perspective. All the best for the future, and yeah, thank you so much.
Thank you.
For viewers tuning just now, we have a breaking news on NDTV Profit. Hyundai